steps in the accounting cycle. In order to, well, what's accounting? It is the language of business. It is a way to record transactions in such a way so as to facilitate the ability to be able to produce financial statements and other, when we get into cost accounting, managerial type reports that we can use in decision making in business. Right? That's what accounting is. So in order to produce these reports, we need to record transactions. What's transaction? The exchange of resources, right? Anytime the business exchanges resources with any entity, person, or business outside of itself, that is a transaction. You're transacting business. So we want to write it down in such a way so as to be able to produce financial statements and other reports. So the first thing we do is record these transactions. Okay, so that's step one, is to record the transactions in a journal. And that's what we're going to study first. Once the transactions have been recorded in the journal, what's next?
The unadjusted trial balance.
Okay, we produce an unadjusted trial balance. Well, actually, I guess we need to post them into the ledger first. Okay, let's post them into the ledger. Everybody remember the term posting? Mm-hmm. So that is the act of transferring a transaction from the journal over into the ledger. Now, of course, all this is done electronically. You know, I shared with you before that even when I studied accounting, the only time I recorded transactions manually in a journal or in a ledger was in a classroom. Because I started writing software in the late 80s. Yeah. And so I've always done it on computer. It's always done electronically. So posting is a matter of pushing a button, right? And all the computer does is takes the transactions that you've recorded in the journal, dumps it over into another database. Okay, that's what posting is. But of course, we learned how to do it the old-fashioned way in class by taking the transactions, finding the right page in the ledger, right? Recording the debit over in the cash account, and the credit over in the owner's equity account, right? So we posted those transactions. So that's step two, to get them in their proper order inside the ledger. All right. Then next is to, anytime we post, we want to do a trial balance. What's the purpose of a trial balance? We try the accounts to see if they're in balance. Humans make mistakes, right? Computers don't. Okay. So if we simply pushed a button and caused these transactions to be dumped over into a permanent file, computers are not going to make errors with that. But back when we used to do it the old-fashioned way, we transfer transactions from the journal over to the ledger. Humans make mistakes. They'll transpose numbers, they'll slide numbers. So it's easy to make an error if you're a human. Okay. So what we would do after we posted the transactions into the ledger is we would do a trial balance. And as Alex pointed out, in this case, it's an unadjusted trial balance. Okay, so we're simply listing all the debit accounts and all the credit accounts, their totals, adding up the debits and credits to see if we're in balance. Remember that? An unadjusted trial balance. Okay. Number 4. All right, we've recorded all the transactions, but we know that some accounts are based on estimates, not a transaction, right? For example, depreciation. What is depreciation?
So wearing
Estimated.
Using up of an asset.
Good. But what kind of asset?
A long-term.
Fixed asset. Good. Or a long-term asset. Exactly. Okay. So what is a fixed asset? It is what? Tangible, long-term, right? Which means it's going to last what? Longer than a year, and
Has economic value.
it has economic value, which means it's an asset, but it's being used in the business. So the 3 attributes of a fixed asset: long-term, tangible, we can touch it, and it's being used in the business. So of course, if it is tangible and we're using it, it's going to what? Wear out, right? So therefore depreciation. Okay, so anytime we buy a long-term asset, then we're going to depreciate it over its estimated useful life. Does that make sense? Okay. So depreciation is one of those adjustments that is simply an estimate. So the only way we can get depreciation into our general ledger is by doing adjustments. Okay. What's the other adjustments that we need to make? What about that insurance policy that we bought? Okay. When we bought an insurance policy, what's the journal entry?
You paid,
Good.
and it's,
What'd you buy it with?
the debit, no. You credit cash, you debit prepaid.
Exactly. Okay. So you paid it with cash. You bought prepaid insurance, right? Because it's what type of account? What's prepaid insurance?
Don't tell me. We used to talk about this yesterday. Don't say it. It's I forgot, but I remember what it is.
Okay. It's an asset, right? Because it has future economic value.
What's
So
a specific type of asset? So,
it's a
what's the word? What's the word?
prepaid.
No, it's another word. It's
Oh,
another
you're
word.
deferring, recognizing it as an expense because it's not used up yet. Good. You're remembering deferred asset. Good. And that's another thing that we need to review as well is those terms. So anytime you have something that needs to be allocated to an expense account because of whatever method, so like insurance is used up over time. You buy a policy that covers you for a period of time. So as time lapses, you record the expense. Fixed assets, it's as you use them because you're using that delivery truck, you're recording depreciation expense. So anything that we're allocating like that based on any other method, we're just simply recording an expense over using some other method other than we just paid for it. That's going to require an adjustment. Also, accruals. Okay, so let's look at those definitions real quick since you brought it up, Stephen. All right, so we have deferred revenue. What's the definition of deferred revenue?
We got paid, but we don't want to recognize it yet.
Good, we got paid, so we've already received somebody's money, but we're deferring recognizes that as revenue. Why? What's required in order for it to be revenue? What is revenue? Everything the company earns. Okay. So if we've not earned it yet, we're deferring recognizing it in revenue as revenue until we earn it. What do we call it? Okay. Anything unearned, right? So if we're a subscription company, we're a magazine company. And so you buy a magazine subscription for what? A year, sometimes 2 years in advance, right? So that magazine has your money, but they're not going to earn it until they've sent you that last magazine, right? Okay, so they're going to earn it over time as they send you a monthly or whatever magazine, but it's unearned revenue. They're going to defer recognizing that money that they've already received until they've literally earned it. Okay, so anything unearned is called deferred revenue. What about deferred expenses? And that's what Stephen's talking about. So it's something that we have what? Paid, and it's going to be an expense, but we're deferring recognizing that expense until when?
It's incurred.
Incurred. Very good. Okay. So we've already paid for it, but we have not incurred it as an expense. For example, the insurance policy, we paid for it, but what's the definition of an expense? It's a used up asset, right? Okay. Assets, when they get used up, become expenses. So even though we paid for this insurance policy, so it's anything prepaid, not just insurance, but like supplies, that's a prepaid expense, right? Because you're never going to sell it. It's an asset, but you're never going to sell it. It's going to become an expense. It just hasn't yet. Okay, so anything prepaid and also supplies, which is a prepaid expense. Okay, so they're called deferred expenses. Why? We've paid for them, but we're deferring recognizing them as an expense until they meet the definition of expense, which means they've been used up. Because that insurance policy still has future economic value, it's not an expense, it's still an asset. Okay, good. All right. So next definition we need to look at is accrued revenue. What's accrued revenue?
But not yet received.
Good. Earned, not yet received. So what would that be? Accounts receivable? Good. Accounts receivable. All right. Because I earned that money. So when I sold it or when I finished that job, I earned the money. So I credit a revenue account, but I've not yet received it. So I debit a receivable account. So anytime I want to make an adjustment, right? We're talking about adjustments here. If I'm accruing revenue, when do I record revenue? As it is
Okay, no.
earned. Good. Okay, we incur expenses, we earn revenue. You're getting there. Okay. Okay, so we record revenue as it is earned, regardless of when the money flows, right? So there are three ways that money can flow, right? Before we've earned it, when we earned it, or after we've earned it, right? So if we get paid before we've earned it, it's deferred revenue. Okay. If we get paid after we've earned it, it's accrued revenue, right? Revenue gets recorded when it's earned, regardless of when the money flows. All right, make sense? Okay. And of course, if we get paid as it happens, it's a transaction and we dealt with it up here. Does that make sense? All right. So three different ways.
So this is the accounting cycle? This is what you're talking about?
Well, we're on step 4 of the accounting cycle. So I just want to throw these definitions in because these are the adjustments. Okay. All right. So anytime we have revenue that we've earned and not yet received, we may need to make an entry to accrue that. And that's called an adjustment. Right? It's not a transaction, it's an adjustment, right? So for example, if maybe a customer owes us money on a note, they bought some stuff, and instead of paying for it within 30 days, which would be an account receivable, they decide, I'm going to sign a note so it gives me 60 days or 90 days or whatever. Okay. Anytime there's a note receivable, it incurs what? Interest, right? Okay, so if a customer owes me a note and they haven't paid it yet, I'm earning interest that I have not yet received. So I need to accrue that interest income. Does that make sense? What's the journal entry? To accrue interest income. Customer owes me interest on a note and they haven't paid it yet. What's the journal entry?
Credit or debit cash.
I haven't received it yet.
Debit, receivable.
Receivable.
Credit. No.
Do you also credit or debit interest?
Interest receivable.
Yeah.
Okay.
I didn't want to say notes,
It's okay.
but I guess that was.
This is just, this is reminding us of all these terms. We're going to be using these all semester. So, we just got to go back and remind ourselves of what these terms mean because that's going to be important. So the definition of accrued revenue is earned, not yet received. Always, the journal entry to accrue revenue is going to be a debit to some receivable and a credit to some revenue account. Why? Revenue is recorded as it is earned. What's the definition? Earned, not yet received. So if it's not yet received, it must be receivable, right? So we're always going to debit a receivable, credit a revenue account.
So on the accounting equation, where is the revenue? Like, how it has all like the subsections. So where is the revenue at on that? If you
It's
get
down here under retained earnings, remember?
yeah, okay. I get you.
Okay, good. Okay, it's all coming back, right? I know y'all slept over the summer and you've forgotten some of this stuff. Remember, you're an accountant for life. You can never forget this. You can never. I don't care when you're getting ready to draw your last, you can say, revenues of debt, or is a normal balance is a credit, and the journal entry for accrued revenue is debit, receivable, credit revenue, right?
When you explain it, most of it is just logical.
It is, it's logical, and I try to teach it logically.
After you explain it, it's like, well.
But repetition, you're gonna get that in your head because of repetition. And of course, we're taking notes. And reviewing those notes is gonna be key to remembering it. It's a lot to remember. I know that, and human memory is fallible. That's why we have to keep bringing it back so that it gets recorded in our long-term memory. So pretty soon this becomes tacit knowledge. You know what the word tacit means? Tacit knowledge. It's like peeing. You don't have to think about it, you just do it, right? Okay, so accounting will become tacit knowledge. Eventually, it just takes time, practice, just like football or any other sport, soccer, whatever, right? It's just, if you practice it enough, it becomes tacit knowledge. Okay, all right, so in that example, if a customer owes us interest, what's the journal entry? Debit interest receivable, credit interest revenue. Okay. Somebody owes us, we made a sale on account and we haven't recorded it yet. Debit accounts receivable, credit sales, right? So it's always going to be a debit to a receivable, credit to a revenue.
So what if they owe you, say they write a note for 30 days and it's collecting interest? They owe you that money plus interest.
Yes.
It's still just debit, interest receivable.
Well, so in the accounts receivable, well, actually it's going to be in the note receivable account. So you're going to have note receivable, which is, the amount that they charged on the note. And then you're going to have a separate interest receivable account.
So it's two separate
Yeah.
entries.
Generally. I mean, you could put it in the same, but because it's owed together, but generally you keep it separate because they may pay this separately too. They could be making interest payments throughout and then later paying the full principal, or they may pay them together. Okay. But of course, we need to know the difference because this is always going to be the face value of the note. Good questions. Okay, all right. Accrued expenses. What's the definition?
Incurred, but not yet paid.
Good. And if you remember that, you can figure out the entries, right? Remember, anytime you're learning new information, if you remember the whats, if you remember the whys, you can rebuild the whats. But don't memorize the whats. Remember the whys. What is the definition? Why do you do this? Okay, what's accrued expenses? Incurred, not yet paid. So if you can remember that, when we incur an expense, what's the journal entry?
Debit cash.
No cash involved. When we incur an expense, what's the journal entry?
Credit accounts paid.
Not necessarily. When I incur an expense, what's the journal entry? I'm just talking about one side. What's the normal balance for expense? What's the normal balance for expense? Get out of the bank. Debit, okay, normal balance for expense is debit. So revenues are credit, expenses are debit, dividends are debit. Don't forget your normal balances. Okay, so anytime I incur an expense, I'm going to debit an expense account, right? So if I have not yet paid it, incurred, debit expense, not yet paid, what am I going to credit?
Liability.
A liability. So always, when I'm accruing an expense, what's the journal entry? Debit an expense, credit a payable. Right? Okay. So say I've signed a note at the bank. So I owe a note payable. Every month I'm incurring interest on that note, right? And I haven't paid it yet. What's the journal entry to accrue interest on that note? Debit and expense, right? Interest expense, credit interest payable. Make sense? So always, when I'm accruing an expense, debit and expense account, credit and payable. So you have those, and then you have your systematic allocation, like depreciation and insurance expense. that's pretty much going to be your adjusting entries. Okay? And that's step 4 of the accounting cycle, is to make your adjustments. So all you're doing in step 4 is you're taking your unadjusted trial balance, looking at all the accounts, accounts, your cash account to see if anything needs to be adjusted, your accounts receivable account, your fixed assets, recording depreciation, going on down. If you have notes receivable, you may need to accrue some interest on those. So you're just looking at all your accounts payables. If there's anything needs to be adjusted, do you need to accrue any interest payable? If you have some unearned, maybe you've now earned it, right? If you had some unearned revenue and now you've earned it, what's a journal entry?
If it's the cash you would.
No cash. I got the cash a long time ago. If it,
Oh, okay, so we already got the cash.
Yep.
You would.
It was unearned previously, now you have earned it.
I know it. I just gotta write it out because I can't think about it.
Okay,
Yeah.
write it out.
You write down like the entry.
Sure, okay. So anything that's unearned, what does that mean? Somebody paid me up front, right? What was the journal entry when I received it?
The liability.
It's a liability. So
Yeah, so
debit
you got
cash and credit unearned subscriptions, okay, when I got the money, right? And then when I have earned it, what's the journal entry? I got to eliminate the liability, and now I've earned it, so I'm going to credit what?
Credit.
Anytime I earn money, I'm going to credit revenue. Exactly.
So revenue is the
Credit.
okay.
Okay. So if I'm a newspaper and I have all this money in subscriptions, I have unearned revenue, right? Or unearned subscription money, whatever they call it. So I've collected all this money, debited cash, credited unearned revenue for all of that money. And then as I send those magazines out, I'm earning that money. So I'm going to do what? Reduce the liability account. So now I owe less than I did before and credit the revenue account because now it's earned. Does that make sense? And of course, that's not a transaction, right? Because the transaction happened a long time ago when I got the money. So this has to be an adjustment. So as I'm doing my account analysis, I'm looking at my unadjusted trial balance and I come down to unearned revenue. Oh, I got to look and see if some of that's earned, right? And I have to make this adjustment because I want my financial statements to be accurate.
You're at 310 College Street, Marbleville.
So I analyze that unadjusted trial balance in order to see if anything needs to be adjusted. And that's one of the things, okay?
Okay, so what are we debiting since we're crediting revenue?
You're reducing the liability
So you would debit unearned and then, okay. I
and
get it.
credit earns.
Yeah.
Good.
Because the accounts have to balance.
Exactly. Exactly. Okay. So I'm going to make my adjustments. Okay. All of my adjustments, everything that needs to be adjusted, I'm going to make those journal entries. And then of course, after I've made the entries, what I have to do, post it into the ledger, right? I'm going to transfer them out of that adjustment journal into the ledger. Of course, again, electronically, I'm going to push a button that says post, right? All right. Then what do we say? Every time we post, humans make mistakes. So we're now going to do a what?
Adjusted trial balance.
An adjusted trial balance. We always try the accounts to see if we humans made an error, right? So it's an adjusted trial balance. Okay. Then we can do our financial statements because theoretically we're complete. All the accounts are accurate. So remember how we did the big worksheets and we got over to the adjusted trial balance and then we moved all the revenue expense accounts over to the income statement columns and we calculated our net income. Then we transferred all the balance sheet accounts over to the balance sheet. We calculate our ended retained earnings and now lo and behold, we balance. Okay, so that is preparing our financial statements. All we had to do in order to do the income statement, statement of retained earnings, and balance sheets, just transfer those numbers off the worksheet onto the proper format, and that's our financial statements. Okay, so once we've done that, so then we prepare financials, prepare financial statements, and then we're done. We're up to the end of the calendar year or fiscal year, whichever the case may be. So what do we do now?
We closed the book.
We close the books, close the entries. So if we were to look back at the accounting equation, we remember that some accounts are permanent and some are temporary, right? Who can tell me which is which?
Revenue account is temporary.
Good.
Cash account is permanent.
Yep.
Yeah.
The cash account, we hope it's permanent, right? We hope we get to keep it some, at least for a while.
Expenses permanent.
No.
Not,
Mm-mm. Oops,
oh, no,
where's
actually,
my
'cause-
head?
no, it doesn't.
Okay, count equation. Remember this breaks down. Everybody remembers this, right? You're an accountant, you can never forget this. Never, never, never can you forget the accounting equation. Can't. It's wet. Oops. What am I doing? I'm trying to do the same thing again. All right, revenue, expenses, and dividends. And I've started adding, just because I'm gonna need this later, I've started adding plus gains and minus losses. Okay, so just to remind us, the county equation, assets, everything the company owns. So in order to get assets, we had to finance them somehow, right? What's two ways to finance? Debt and equity, right? Two ways to finance assets. The equity could have come out of the pocket of the owners. We call this what?
Capital.
Contributed capital, right? And then retained earnings is what? Everything the company has earned from the beginning of its life until now that it has not paid out as a dividend, right? That's what retained earnings are. That's why we call them retained. It's what we've earned and we have not paid it out, but we've retained it or kept it, okay? How do we calculate retained earnings? Everything we earn, which is revenue, minus expenses, which is what it cost us to earn that revenue, right? Minus dividends, which is the money that we paid out to the owners. Thank you very much for letting us use your money. Here's your dividend, right? Okay. Also gains and losses, okay? If we sell a long-term asset, something that we've been using in our business and now suddenly it's a delivery truck. We don't need it any longer, okay? And we sell it. If we sell something that we sell in the ordinary course of business, that's inventory. When we sell it, it becomes revenue. If it's a long-term asset that we were using in the business, like a delivery truck, if we sell it for more than what we have in it, it's a gain. If we sell it for what we have less than what we have in it, it's a loss. Okay, so I like to throw that in now. Gains and losses. So this is selling a long-term asset that is not something that we sold in the ordinary course of business. Does that make sense? So if we're selling shoes, every time we sell shoes, that's earning revenue. If we're selling subscriptions, every time we send out a magazine on that subscription, we're earning revenue. But if we sell, maybe we bought a bond because it had a nice interest rate on it. When we sell that bond, we sell it at a gain, we record it as a gain. Okay, if we sell it for more than what we had in it, it's a gain. If we sold it for less than we had in it, it's a loss. Okay, does that make sense? So gains are like revenue and losses are like expenses. Okay, these are good. Okay, and then if we look at the normal balances, everything on the left-hand side is a debit. Everything on the right-hand side is a credit, right? Liabilities and owner's equity are credits. Debit, left, credit, right? Remember the song that we sang? You know what we sang. Okay, capital is contributed. It's a plus. Owner's equity is a plus. So this must also be a credit. Retained earnings is a plus. Owner's equity is a plus. So that must be a credit. Revenue's a plus. So it must be a credit. Expenses are minus. So it must be a debit. Dividends are a minus. So it must be debit. Gains are a plus, so it must be. Losses are a minus, so it must be good. Okay, so you can never forget your normal balances. I'm telling you on your deathbed, Stephen. Okay, you're gonna be rattling that off to your family as they're gathered around you. Right? Okay, all right. So in closing the entries, to finish this. We're gonna close out all of the temporary accounts. Your temporary accounts are here. All these accounts get closed into retained earnings at the end of the period. All these are permanent accounts. So they're called permanent or real accounts. We don't close them out. These are called temporary or nominal accounts. And the reason for that is we want to track revenue for a period of time, right? How much did we earn for this quarter, this month, this year? Okay. We don't care how much we earned 15 years ago. We need to know how much did we earn for this period. Okay. So after this period is over, we're going to close it out and start over. That year's gone. Close it out, start over, right? Same thing with expenses. How much expense did we incur this period? Okay, so we don't care about last period. That's done, gone, over with, right? Dividends. How much did we pay out in dividends this year? Gains and losses, same thing. What happened this year? So at the end of the period, when all this is over, we want to close all these accounts into retained earnings, right? So revenues minus expenses equals what? Well, revenues minus expenses plus gains minus losses equals net income, right? Net income gets closed into retained earnings. Dividends also gets closed into retained earnings. All right, that's what we call the closing entries. So what we have to do is look at the normal balances, right? We want to close out all the revenue accounts. So if we were to manually make these entries, and this is kind of foolish, I've always hated this, but in order to close out a revenue account, if you read the textbook, it says to debit the revenues, okay, and credit us a silly account called income summary. I've always thought that was dumb. And all income summary is some kind of little temporary account that you use just to hold the net income until you're ready to close it into retained earnings. So in the computer world, one of my lives I spent as a software engineer, so I write accounting software. You don't use income summary. That's a waste of time and computing power, right? So I simply debit revenue and credit retained earnings. Skip the middleman, all right? Okay. And that closes out your revenue accounts, right? Because all the revenues have a credit balance. In order to get rid of that balance, I'm going to debit it for the amount that's in that account, right? So debit revenue, credit retained earnings. All my expense accounts need to be closed out. What's the normal balance for expense? What's the normal balance for expense? Debit, right? So all my expense accounts have a debit balance. How am I going to get rid of it, Stephen?
You're gonna credit it.
I'm going to credit it. So I could debit income summary, or like time is money. I'm not wasting time with income summary. I'm going to debit retained earnings and credit all my expense accounts. And that closes the expense accounts out to zero, right? Same thing with dividends. What type of account is dividends? It's actually an owner's equity account, right? It's not an expense account. It's an owner's equity account. But its normal balance is debit. In order to get rid of it, what am I going to do? Credit it, right? So in order to get rid of dividends, I'm going to debit retained earnings and credit dividends. Gains, temporary account, credit balance. How am I going to get rid of it? I'm going to debit gains.
But if you're debiting, if you putting all this in the same account, like what if the account is negative?
If sometimes, and sometimes it happens, right? We might have a contra expense account, right? So we might like have a discount account. Occasionally it happens. The normal balance for expenses debit, but occasionally you have a credit balance out there. So you just do the opposite. Okay. Normally we're going to credit the expense accounts, but if it happens to have a debit balance, you're going to debit it. Or if it happens to have a credit balance, you're going to debit it. Good question. Okay. All right. So gains have a credit balance. So I'm going to debit them, credit retained earnings. Losses have a debit balance. So I'm going to debit retained earnings and credit losses. And that's my closing entry. So I'm going to close all these accounts out. I'm going to look at this adjusted trial balance, see what the balance of each account is, and I'm going to make the journal entry that makes it go to zero. That's my closing entries. And of course, I'm going to continue this. I'm actually going to post them from a journal into the ledger, and then I'm going to do a post closing trial balance. After, post means after closing trial balance. So what's going to be left on the post-closing trial balance? Just your permanent accounts, right? Temporary accounts are gone now. But humans make mistakes, right? So anytime we're posting, we could have made an error. So we always do a trial balance to make sure we're still in balance. Okay. Questions about that? Okay, so now, what am I doing on time? Let's look at some journal entries. So let's go over that exercise 3.3. So it says we sold $700 worth of office equipment that had a cost of $2,000 and accumulated depreciation of $1,500. What's accumulated depreciation? Do what? It went down in value. Good. So what type of account is accumulated depreciation?
Credit.
It has a credit balance. What type of account?
Contra asset.
Good. Contra asset. Good. How's this? Something's got to give. I need a new pen. But what I need, what I need. Okay, so accumulated depreciation. What's the journal entry to record depreciation?
That's it. Oh, no, debit, you would debit, you would debit. Appreciate it.
Good.
Depreciation expense, not.
Yes, that's it.
That's
Debit depreciation expense.
And then you credit accumulated
Good,
depreciation.
good.
I thought it was another name for that account. Cause it wasn't depreciating an expense because you said depreciation is not expended. That's what you were selling in the last one.
Well, depreciation is not outlay of cash, but it is an expense. Okay, so depreciation expense. So whenever we record depreciation, the entry, until we get in the cost accounting class in a few minutes here, is always going to be debit depreciation expense credit accumulated depreciation. Now in cost accounting, because we're dealing with manufacturing, the entry is different. So we'll talk about that later. But generally in financial accounting, the entry to record depreciation, debit depreciation expense, credit accumulated depreciation. So what we have here is we've sold some office equipment. So this is one of those gain things, right? Gained or loss. This is office equipment that we previously used. We probably worn it out. It's junk now. And so now we're selling it to somebody else, but one man's trash is another man's treasure, right? So somebody's wanting to buy it. Okay. So it says that we sold for $700. So we received $700. What's journal entry?
Cash, debit,
Debit cash $700. Okay. And it says that had cost us $2,000. What does that mean? What's historical cost principle say? Historical cost principle. Remember that in 272 class. Fixed assets are always recorded at, and they're maintained at historical cost. One reason that GAAP is dogged, right? In international standards, not like that. They let us adjust to fair value. But they like to dog US GAAP because we still require fixed assets to be recorded at historical cost. So what they're telling us is that asset, when we purchased it, cost us $2,000. So in US GAAP, our entry to remove it, now that it's been sold, is to credit the asset account for its historical cost. So since it's equipment, okay, fixed asset, normal balance was debit. So now that we've sold it, we're going to credit the equipment account for $2,000 to remove it. We no longer own it. It's gone. Okay, does that make sense? And of course, also under US GAAP, we depreciate fixed assets. So not only is the asset gone, but its associated accumulated depreciation is gone, right? So in order to completely remove it from our books, we have to also remove the accumulated depreciation related to it. So what does it say? It says it has associated accumulated depreciation of $1,500. They tell us how much. So as we said, accumulated depreciation is a contra asset account that brings an asset down to its book value, right? Book value of an asset, what's the formula? Cost minus accumulated depreciation, that's book value. Okay, so in order to get rid of that asset completely, we have to get rid of that credit balance in the accumulated depreciation account. So debit accumulated depreciation, $1,500. Does that make sense? Because the asset is gone, we have to remove from the accumulated depreciation account the depreciation that went along with that asset.
So accumulated expense would not be on here.
Nope, no expense. What's expense? The using up of an asset. We're not using the asset any longer, it's sold. Okay, so we're selling it.
So even though we sold it for 700, bought it for 2,000, but we still have a gain since the depreciation was 1,500,
What's the carrying amount of the asset? What's the book value of that asset?
2,000.
What's the book value? What I just told you,
Oh, 500.
500. Okay, so if we sold an asset that we're carrying on the balance sheet at 500 for 700, we have a gain, loss, what do we have?
Okay.
We have a gain. What does it take to make this balance? Gain on sale, $200. Does that make sense? Okay, because according to our balance sheet, what's this asset worth?
2,000.
$1,500 or $500, right? Cost minus accumulated depreciation. So the carrying amount or the book value of that asset is $500. We sold it for $700. So we sold it at a gain. So credit gain on sale. What if we'd sold it for $300?
You would have a loss.
We'd have a loss because its carrying amount is $500 and we sold it for $300. So we had a loss on sale.
And you would still credit loss on sale?
We would debit it.
Debit?
Because gain normally balances credit, losses are debit,
Oh, and it balances.
and it balances. Yep. So if you looked at that transaction and you said, dang, what am I going to do now? I got debited cash and I'm crediting equipment, debiting accumulated depreciation. What do I need to balance? I credit $200. What the heck is it? And then your brain says, oh, you need a credit of $200. You sold this thing for more than it was worth, so you must have a gain. By the same token, if you only received $300 and you've got a net credit of $500, you need a debit of $200. So, oh, gee, you must have sold it at a loss, right? Does that make sense?
Why do we debit the accumulated depreciation? Is it because it's a contra asset?
Because it's a contra asset. So remember, every time we recorded depreciation for this piece of equipment, what do? Debit depreciation expense, credit accumulated depreciation, right? Every time. So when we sell this asset, we have to get rid of this accumulated depreciation because it's gone. Okay. So if there's $1,500 in the accumulated depreciation account for this equipment, we got to get rid of it. Good.
Oh, the accumulated depreciation, it's normal balances, credit.
Right. Because it's a contra asset.
Yeah.
So assets are debit, so accumulated depreciation is credit. Good. Is it all coming back? Okay. Just like a dream, huh? Okay. All right. So that's that transaction. All right. Next, made sales of $2,000 on credit. The cost of the inventory sold was $1,200. So we made sales of $2,000 on credit. What's journal entry? If we made sales, we did what? Did we earn money?
Yeah, we earn
The
revenue.
revenue,
What's the revenue account? If we sell stuff for a living, what's the revenue account? What's Walmart's revenue account? Now in accounting, what's my revenue account? Fee income, right? But if I'm selling stuff, that's how I earn my money. My revenue account's called sales. Okay, remember that? Okay. So if I sold $2,000 worth of stuff on credit, anytime I earn revenue, I'm going to do what? Credit a revenue account. If I got paid, I'm going to debit cash. If I didn't get paid, debit accounts receivable. Okay. So debit accounts receivable, 2,000. Credit sales, 2,000. Sorry, I don't have a pen that works apparently. Okay, does that make sense? All right, so that's a sale on account. We debited accounts receivable because it's an asset, normal balance is debit. That increases the amount of money that's owed to us by our customers. Anytime we earn money, we're going to credit a revenue, right? So if I'm selling stuff, that's how I earn my money. The revenue account is generally called sales.
Say the cost of the inventory was 1,200.
So why are they telling us that? So what's inventory? Everything that I own that is available for sale in the ordinary course of business, right? Inventory is an asset. It's something the company owns. When we sell it, it's like that delivery truck. It's gone, right? So we have to get it out of the inventory account. So how do we get it out of the inventory account,
You
Dave?
can credit inventory, but I don't know what the debit balance is for that.
So if we're crediting inventory, that asset got used up, right? Anytime an asset's used up, what's your debit? The using up of an asset is
Expense.
expense. What's the expense account related to inventory?
Cost of goods sold. That is?
Hallelujah. Cost of goods sold. Does that make sense?
Yeah.
And it is what it says it is. What is cost of
Oh,
goods sold?
okay,
It's the
okay,
cost of the
okay.
goods that we sold. Okay, makes sense? So debit, cost of goods sold, which is an expense account for the amount that it cost us, right? Historical cost principle, inventories in the books at cost. Okay, so cost of goods sold, credited inventory 1,200, bam. And this is what we call a perpetual inventory system, right? Remember that? We studied two different systems.
Perpetual and then
Period.
periodical.
Good.
Yeah.
What's the difference between the two? What's perpetual mean?
Every time in a periodical, you just go around and then such that it's like per period kind of.
Exactly. Good. So perpetual is we perpetually or continually or always keep up with how much inventory that we have. In a periodic system, we don't record cost of goods sold as we sell the items. We periodically count the inventory, and that's why we have to use that formula to calculate cost of goods sold. Who remembers what the formula is?
Beginning inventory
Good,
plus purchases
Good.
minus ending inventory.
good. Equals beginning inventory plus purchases minus ending inventory equals cost of goods sold. We know what we had at the end of last year, right? We know how much we bought this year, right? Because we paid for it. We have invoices to prove it, okay? And payments to prove it. We counted the inventory at the end of the year. That's a periodic system. We periodically count the inventory. Whatever's left, we're going to subtract that, and the difference is cost of goods sold. Okay. And your brain may say, well, just because it's missing doesn't mean it was sold. It could have been stolen, broken, rotted on the shelf, right? And that's true. But in business, that's still a cost of owning inventory and having it out there for the public and your employees being able to steal it, right? So it's still cost of goods sold. Does that make sense? Okay. So in a periodic system, we have to use this formula to calculate cost of goods sold. But in a periodic system, it's usually larger companies like Walmart that have a fancy enough system that knows the cost of that item. I always think about it when they run your stuff over the little scanner thing at Walmart, it goes beep, right? Every time it beeps, it makes this journal entry, except you're going to debit cash, right? Because you're going to pay for it as soon as they get through beeping, all right? So you're going to debit cash, credit sales, debit cost of goods, and credit inventory because the system, because that UPC code on the underwear that you just bought says that it cost them $3.49, even though they sold it to you for $9.59. Okay, right? All right. So the journal entry, that's a perpetual inventory system. Every time they sell an inventory item, it's going to debit cost of goods sold and credit inventory. Does that make sense? That's a perpetual system. But if you're a little mom and pop, you're not that fancy. So at the end of the year, you count your inventory at cost and you calculate your cost of goods sold this way. Good? So in a perpetual system, it takes 2 journal entries to record a sale. In a periodic system, it's only 1. We don't have the information to record the second entry. We're not maintaining that information. So we only record the sale. And then at the end of the year, we calculate the inventory. Then we record cost of goods sold. All right. Next, how am I doing? Purchases $1,000 worth of inventory for cash. Journal entry.
Debit, or your credit card.
Good.
Or
Debit, inventory, credit, cash. Don't make it harder, Steve. Oops. Debit, inventory, credit, cash. How much?
1,000.
All right. Let's see, what's next? Purchased new equipment costing $4,000, paid $1,500 and signed a note for the rest. What's journal entry?
heavy equipment for
Debit equipment, right? What type of accounting is equipment?
asset.
It's an asset, good. So debit equipment, because it's a debit balance. How much was it? $4,000. Remember, historical cost. So it doesn't matter if the list price for the equipment was $5,000, the manufacturer's suggested retail price was $5,900. It doesn't matter that we're only paying for part of it. We're going to record the equipment at historical cost. What was the final cost of that item? Okay. So debit equipment for $4,000. We paid $1,500. What we pay it with?
Cash.
Cash. Debit or credit?
Credit.
Credit, because we're going to reduce cash. Its normal balance is debit. Okay. And then it says we signed a note. What type of account is a note?
Liability.
Liability. What's normal balance for liabilities?
Credit.
Credit. So we now owe more than we did before. So we're going to credit note payable for $2,500. Right? Is it coming together? Good. All right. Next. Received a check on June 7th for the credit sale for the June 7th credit sales. So remember back on June 7th, we sold somebody some stuff for $2,000. Now we're getting paid. What's a journal entry?
It would be debit sales, credit.
Ah,
No,
Debit cash.
when are you ever going to debit sales?
you close the entry.
Good. It's going to come from the accounts receivable. What are you receiving?
Cash.
Cash, debit or credit?
Debit.
Debit, good. So debit, cash. How much money?
2,000.
2,000. And it's going to come from the accounts receivable, Mary Jane says. So when we sold it, we debited accounts receivable. Accounts receivable is what type of account?
Liability.
It's an
Asset. Okay.
You
That's
got
okay. It's
to
coming.
clear that balance though.
Okay. So we have to clear that balance up. Now we've been paid. So we're going to credit accounts receivable for $2,000. Okay. Good. So if we were to look at that on the T account, when we sold it, we debited accounts receivable for $2,000. Now that we've been paid, we credited it for $2,000. We had to eliminate that debt. Good. It's like a bucket. Every account is a bucket. All right, next. All right, made cash sales 4,200. Cost of inventory was 2,300. Made cash sales this time.
Debit card.
Debit cash. 4,200. What we got credit?
Credit.
Which one? Which is what's
Sales.
sales? Good. Which is our revenue account. What's the rest of it?
Debit cost of goods sold.
Good. Debit cost of goods sold
Credit inventory.
and credit inventory for
1,500.
50.
No, it was 2,300.
2,300, okay. And I always like to tell students that if you're using a perpetual inventory system, when you look at the two entries, because students get confused sometimes about what to put in that second entry. That second entry is removing the inventory at cost. So when you're looking at the journal entries in a perpetual system, you ought to see your gross profit, right? What's the formula for gross profit? What's the formula for gross
Minus
profit?
expenses,
What?
revenue minus expenses. Oh,
Formula for gross profit.
Sales minus cost of goods. Right?
Good. Sales minus cost of goods sold. That's formula for gross profit. You can, don't ever forget this stuff, Stephen. I'm telling you, never forget this stuff. You can never purge these formulas. Okay. So when you look at that journal entry, you ought to be able to see your gross profit. Sales minus cost of goods sold. What was the gross profit on this entry? 1,900, right? Okay, so students sometimes have a tendency to try to put the 4,200 in the second entry. So if you look back at that entry, you ought to see your gross profit. There's your sales, there's your cost of goods sold. So you know how much money we made on that sale in a perpetual system. Okay, good. Don't get discouraged. This is not easy. If it was, this room was full, would be full of students. All right, purchase $2,600 worth of inventory on credit.
You debit inventory, credit, account payable.
Good. Does that make sense? Somebody tell me why.
Because inventory is an asset,
Good,
and then accounts payable is liability.
good. Inventory is an asset. I have more inventory than I had before, so I'm going to debit inventory. Accounts payable is a liability. So in order to record the additional liability that I owe to this company, I need to credit accounts payable. Good. What else? Return $200 worth of defective inventory from the June 20th purchase on account. So if I return some inventory and I haven't paid for it yet, for a credit on my account, I return some inventory. What's journal entry?
Ah,
Do I own it now? No, I send it back. I'm going to credit inventory. What was 200? What am I going to debit?
the liability.
I'm
The
going to debit the liability. Exactly. Because I returned it for credit on my account, right? Where did I put it when I bought it? In accounts payable. Haven't paid for it yet. So $2,300 is still sitting in an accounts payable account. I now owe them $200 less because I sent somebody junk back, right? Does that make sense? So inventory went down by credit and accounts payable went down by debit because it's a liability account and the normal balance is credit. Good. Let's see, paid for the June 20th purchase minus the return. So June 20th. Was $2,600. Oh, here, it's $2,600, not 23. Okay. So now I'm going to pay the balance. So I bought $2,600 worth of stuff. I sent back $200 worth. So now I'm going to pay them what I owe. What's journal entry? Okay. To what? Cash. Good. And debit.
Inventory.
accounts payable.
Accounts payable. Okay. So if I were to look at that accounts payable account, when I bought this stuff, what did I do? I debited inventory, credit accounts payable, 2,600. I returned some of it. So I now owe 2,400. So now in order to pay it, I need to debit accounts payable for 2,400. Good? Good. Coming together? Now this is, again, this is not easy stuff. So don't get discouraged if you make an error.
talk about like warranties in this class.
Oh yeah. We're going to accrue warranties. Yes, we will do that in this class. And then pay the utility bill for $210. What's the journal entry?
Debit utility,
Expense?
credit cash.
Debit utility expense, credit cash. Okay, so we'll stop there.
It's slowly coming back.
It's gonna come back to you. This is a review.